Okay, good morning, everyone, and welcome to today's Coffee Microcaps morning meeting. For anybody who's joining us for the first time, you're very welcome. For anybody who's a regular attendee, welcome back. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who is joining us for the first time, I'm just going to quickly run through some intro slides here, and then we're going to get straight into it with our first presenter. But first off, I'd like to thank ShareSite, our sponsor of all our virtual events here, Coffee Microcaps. You are looking for something to track your portfolio and tax and dividends and all that good reporting. Please check out the ShareSite software. I'm a user myself, and I can definitely highly recommend it. A quick compliance and disclaimer slide. For anybody who is joining us for the first time here this morning, companies we normally have presenting on here, capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have things from the resources or biotech sectors, so what I like to call industrial microcaps, which covers basically all the other sectors: healthcare, financials, industrials themselves, FMCG companies. Basically anything that kind of falls out of resources and biotech. Structure this morning's webinar, we've actually got 4 companies joining us this morning. Each will have a 30-minute slot, which will break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function in the menu bar. It does make it easier for me to moderate the questions. And please note the webinar is being recorded and will be posted on the Coffee Microcap YouTube channel tomorrow. You can follow us pretty much on all the socials. Twitter's our main one, YouTube for the recording of this, and indeed all our other events that we do. So we've had lots of fund manager interviews recently and some company presentations. So be sure to check out the channel and subscribe there. LinkedIn, and I also do a free monthly newsletter, which you can get on the Substack newsletter platform. Up first, we're going to be joined by Stephen Lydeamore from Immuron. Glad to be welcoming Stephen back. Then after that, we've got Amos Simantov from W2V. And then after a long absence, I'm delighted to say we're going to be welcoming back Sam Riley, founder and CEO of Ansarada. And then we will have Dr. Chris Richards also coming back after a bit of a long absence from Apiam Animal Health Limited. But that's enough from me. Steve, if you want to start sharing your screen, I'll let you know when I can see it coming through.
Okay. Can you see it now?
I can see it on screen now, Steve, so you can take it away whenever you're ready.
Okay, good morning, everybody. Sure why the here we go. Yeah, let's quickly skip over the safe harbor statement. Just a quick snapshot of the company. We are a biopharmaceutical company, but we also have a consumer health business that's revenue generating. So therefore, we fit the criteria of Coffee Microcaps. So we're listed on both the ASX under the ticker IMC as well as on NASDAQ, IMRN. Currently, our market cap's around $17 million. We also have $17 million cash in the bank, so we're not in a capital raising mode at the moment. If you look on the right, you can see the major shareholders. So the first one is Bank of New York Mellon. They're the ADR holder for NASDAQ shareholders, followed by management and board and 2 other entities. No substantial shareholders. I thought this might be interesting to show you status update from the last time I presented at Coffee Microcap. So on the 2nd of May, I presented in person in Melbourne. And at that time, we had year-to-date revenue of 1.78 million, which was up 233% on the prior year. Current status, so we've just completed the financial year 2023 with revenue 1.8 million, up 136%. that's just the start of the growth for our business. In the first quarter of financial year 2024, we've already done 1.57 million, which is great for the business. Our Travelan, our product, and I'll tell you a little bit more about that as we go on, is now the number 2 SKU in Australian pharmacy in the anti-diarrheal category. Number 1 is GastroStop. Some of you may be familiar with that. And another major milestone that we've just completed is that in year-to-date FY24, we've already exceeded full-year Australian sales of Travelan for the last financial year. So growth is very strong. At the time of my last presentation, we were gearing up to launch in the US on our own shop front on Amazon.com, and that was pending establishing safety stock. So during the last financial year, we had some supply chain issues. They've all been resolved. We have established safety stock for all products in all markets, and we have successfully launched in the US on Amazon.com, which is pleasing. Travelan, also known as IMM124E, last time I spoke, we had an IND, so that's investigational new drug application filed with the FDA, and it had received authorization. As of today, we've not only started that trial, we've completed the recruitment and the inpatient phase dosing. So we're just waiting for the withholding period before final assessments are done. Top line results and the clinical study report will be reported in the first half of next calendar year. Another one of our clinical programs is Camp ETEC, which is Campylobacter enterotoxigenic E. coli. At the time of last reporting, a toxicology study report had been completed and submitted to the FDA, and pleased to update you with the current status. The FDA removed the IND clinical hold. The Institutional Review Board has given approval, so that's ethics approval to allowing us to start a study. In the first half of next calendar year, we anticipate that clinical trial will be initiated and completed dosing. We have another Travelan study being funded by the Uniformed Services University. So this is a military university. Time of last reporting, we were 35% recruited in a large trial. So this is a phase 4 trial of our Travelan over-the-counter supplement of 868 patients. And presently, we're up to 50% recruitment. And the last clinical program we have is IMM529, which is for Clostridioides difficile. We had completed the solid dose active formulation development. And at the moment, we're manufacturing a clinical product, which is necessary for an IND filing. And we plan to file pre-IND. So once again, that's investigational new drug application with the FDA in the first half of next calendar year. For those that are new and haven't seen this before, I might just take a little bit of time and explain what our technology is. So the core basis of our technology is around bovine colostrum, and we use the cow essentially as a factory for developing a drug product. Bovine colostrum itself has a lot of bioactives, and some long names listed up there that explain what they are. Those that are familiar with colostrum, all mammals have it, including humans. That's that first milk that's given. Now, in the case of cows, a calf is born without any immunity. So unlike humans, where some immunity is passed through the placental wall, in cows, all of that is passed through colostrum. And so we're taking advantage of that cycle by developing a highly specific vaccine for targeted pathogens. We can give that vaccine to the pregnant cow, and in response to that vaccine, the cow will develop hyperimmune antibody-rich bovine colostrum. So there'll be antibodies in that colostrum that we harvest and process to make a drug product. So we remove the fat, almost all of the lactose, and you get left with a spray-dried powder, which can be compressed into a tablet. Now, we have done extensive preclinical research, and at the end of my slide deck, I'll leave with you a list of references for these. We've also conducted a clinical study, the OTTO study, where we showed up to 90% effectiveness in preventing travelers' diarrhea. And on the back of that clinical trial and the preclinical studies that we done, we have health claims in both Australia and Canada for a long list of gut and liver health. The primary one that we market the product on is on that first one there. That's to reduce recurrence and to relieve diarrhea. So travelers' diarrhea is the key target for our advertising for this consumer health product. Let me give you a little bit of a background on the market potential. So I've already gone through to some extent the sales growth and broken down here between Australia and the US. Australia is the longest established market, and we've penetrated into all retail pharmacy within Australia. In the US, we're now on Amazon.com. We're also selling to travel health clinics, including Passport Health. We're not yet in retail pharmacy, so there's a lot of upside to that. And in Canada, similarly, we are looking to get into retail pharmacy and have yet to launch on Amazon.ca. Good news is that people are starting to travel internationally again, and in Australia, up to July 2023, up that 12-month average was around 77% of those back in the pre-pandemic period of 2019. That's getting closer now to 90%. So when I get the new numbers, I would imagine that number would be closer to 90%. And you can see in the US, it's now almost 100% as of June, and I expect the next reported numbers will show that greater than 100%. So people are traveling again, and if you look at the middle and the right there, the CDC, so the Centers for Disease Control in the US, is estimating that some 30 to 70% of travellers experience traveller's diarrhea when travelling to high-risk regions. So think of Australians travelling to places like Bali, and Americans and Canadians travelling to places like Mexico. And we market Travelan. It doesn't really have any direct competitors. Our challenge is to make people aware that it exists as a preventative product. So it's like travel insurance for your trip. Nobody wants to get traveller's diarrhea while traveling to a warm, sunny destination. We do have a chief commercial officer that was been with the company just over a year now, with a strong consumer health background. He's had leadership positions in both GlaxoSmithKline and also Procter & Gamble in both Asia and the UK, as well as Australia. And as you can see from Australian results, doing very, very well. And we hope to repeat that in the US business. If we look down the bottom on the right, you can see the market potential for Travelan. If we look at 15% market penetration in the US and EU, we'd be looking at 83 million sales per annum opportunity, which is a much larger number than we're currently doing. So a lot of great potential there. Just quickly, where do we distribute? So I mentioned Australia, USA, and Canada. Strong establishment in retail pharmacy in Australia, and to a lesser extent, business to business and e-commerce. In the US, strong in the business to business. That's the travel clinics I mentioned. And I'm marking this as established now in e-commerce. That's our shop front on Amazon. And in Canada, we're working on getting all of those things established. So in Australia, you'll find Travelan in almost any pharmacy that you go to around the country. They're all fully stocked, as are the wholesalers. We do have one other product, Protectin, for gut and liver health, that's sold through Oborne Health Supplies to the practitioner markets. This is health food stores. We're looking at getting into retail pharmacy in both US and Canada, as well as exploring getting our product into international markets. So clearly there's a potential in Europe, and we are looking to get into that market, as well as some parts of Asia. Let me have a look at the clinical programs I mentioned up front. Let's just talk about where they're at. So Travelan has just completed dosing in a phase 2 study, IMM 529 for Clostridioides. We're looking to file with an IND next calendar year in the first half to commence a phase 2 study. The other Travelan study with the Uniformed Services University, this is a phase 4 study of our marketed product, and the CAMP ETEC program is just about to start. We have an IND approval from the FDA, just about to start phase 2 study in the first half of next calendar year. One other point to make about these programs is that both of the Travelan studies and the Camp ETech program are funded by the US military, so the Department of Defense. Travelan study, the phase 2, was under a grant from the Army in collaboration with the Naval Medical Research Command. Camp ETech is another Navy collaboration, and the Travelan phase 4 study is funded entirely by the Uniformed Services University. So these are not drawing upon our cash resources very much. Our cash burn rate is very low. So last financial year it averaged around $200,000 per month. So with $17 million in the bank, we're not looking to raise capital anytime soon. I joined the company a bit over a year ago, and I thought it would be prudent because the clinical programs for IMM124E and IMM529 had both been put on hold for roughly 2 years during the pandemic. Very difficult to conduct clinical trials, but when recommencing clinical trials, the first thing to check is to make sure that the market opportunity is still there. So I engaged a company called Lumanity in the US, one of the leading companies in this space, to look at both desktop research as well as primary research with prescribing physicians. This is a US-based study, and very pleased to see that they came back and said, yes, there's still a market opportunity for both products. And in the case of Travelan, that's IMM124E, they estimated a US market alone of around $102 million. And in the case of IMM529, around $93 million for second recurrence. And this is an important point because Clostridioides difficile is one of those infectious diseases that's treated with antibiotics. That's either vancomycin or phytomoxicin. And 40+% of people, even after being treated with antibiotics, get recurrence. And that's the target market for this $93 million sales estimate. In our trial design, we're looking to include primary patients, and that primary market, which is the antibiotics, vancomycin and phytomoxicin. If you look at the total market, that's around $1.7 billion. So the market potential for a product like IMM529, if you can get earlier in the treatment cycle, is much bigger than that $93 million sales estimate. Looking at milestones, what I'm showing here is where we've come from and where we're going to. So anything that's in blue are things that we have completed, and anything that's in black are things that we're anticipating to be completed. And you can see that we've been quite busy over the last year or so, delivering on the milestones that we've been advising the market are coming up. And before the end of this calendar year, we have another couple, so busy period leading up to Christmas to complete. And in the first half of 2024, we've got a rich milestone reporting period. So that clinical trial in Travelan, the phase 2 that's finished dosing, we'll have the top line results and clinical study report that's anticipated to drive value in the stock. We also plan to both initiate and also complete the inpatient phase of the Camp ETech, Campylobacter study. And much like that Travelan phase 2 study, this phase 2 study is also a controlled human infection model study. And for those that are not aware of what that is, essentially we have healthy volunteers that volunteer to be infected by the bacteria, and we test in a placebo-controlled trial to see whether our product prevents them getting infected by it. So we're looking forward to starting that one. The Travelan phase 4 study enrollment is due to be completed around end of March of 2024, and we'll complete the inpatient phase next calendar year. And hopefully we'll be able to report that one out by the end of the year as well. IMM529, and we plan to submit that pre-IND to the FDA in the first half of 2024. I mentioned right at the beginning that we have a strong research background on Travelan. This is the product that we market that's also in development to become a drug. That's IMM124E. The Otto study, there's a link there to Scandinavian Journal of Gastroenterology. We can look at that study report showing up to 90% effectiveness in preventing travelers diarrhea. On here, we've got a new publication that just came out in, you can see closer to the bottom there, in November 2023 in the Journal of Infectious Immunology, where we showed a microbiome study that was done between La Trobe University and RMIT, showing a non-detrimental effect on the gut microbial communities in unchallenged mice. That report also shows that we had some positive benefits in improving the population of two commensal, i.e. good, probiotic type actives. So a long list of things there. I won't go through all of those. We recently reported results of our collaboration with the US Department of Defense at a medical sciences symposium, and the papers are there on that as well. And IMM 529, there's one published paper showing the 3 mechanisms of action of that product, which shows great potential for Clostridioides difficile. So I might just leave that there, Mark, and open that up for any questions.
Cheers. Thanks very much, Steve. Yeah, you mentioned production issues, have all kind of been resolved. And we did talk about that when you presented at Coffee Microcaps Melbourne, as you say, earlier in the year. I just want to touch on, obviously, with the strong sales growth, and the launch of the Amazon shop, and you do everything, if I remember correctly, there in Melbourne in terms of production, in terms of keeping a pace with the sales growth and the ramp up that you're seeing. Has that caused any issues, or are you kind of comfortable with the production side that you can keep up with I think the rapid increase in sales?
That's a good question, Mark. And you recall when I presented last time, we had set up a shopfront on Amazon.com to launch in the US, and we weren't going to do that until we had established the safety stock. So we delayed the launch until July in order to make sure that we had many months worth of stock, allowing for future growth. So it's better to have too much stock than too little, especially when you're in growth mode. So we've built up stock, and we have strong safety stock positions for all products in all markets now, which is good. The product's actually made in Adelaide in Australia, the tablets, and the packaging used to be done in New South Wales, and that was our supply chain issue, was on the simplest thing as packaging. So taking a tablet, putting it into a blister pack and a secondary pack, and that was because coming out of the pandemic period, the contract packers are overwhelmed with the amount of work that they had to do, and we weren't on the top of their pecking list. And I was unable to find anybody in Australia to do the packing, and had to go overseas, and that required a TGA GMP certificate. And the TGA's also got resource challenges that took more than 6 months for them to pick up the file and look at it and give the tick of approval. But that's been done now, so we're all good.
Yeah. And then just on the expansion into the other markets, you referenced Canada there, and maybe if we extend into other international markets that you're going into, now that you've kind of got the Amazon setup experience for the US, is that kind of the preferred route to market to start off? Is get whether it's Amazon.co.uk or Amazon Canada, like get the kind of ball rolling in an online sense, kind of through the Amazon network? Because I can imagine trying to get ranging in these like retail pharmacies, that can be quite a long drawn out sales stocking kind of process. Maybe just talk through that expansion into Canada, and how you would see further international expansion into some of these other markets.
Yeah, you're right about the ranging process for pharmacies. So we've just started the process of pitching for getting into retail pharmacy chains in the US, and we'll soon start doing that for Canada. They typically, a bit like Australia, only do that once a year, and you have to wait for that opportunity. And even if you're successful, you're waiting until essentially the following year before you actually get your product on the shelf. So it's about a 12-month cycle. So it's not a quick way of getting the product into market. Amazon is, and you mentioned the UK, that's probably the next biggest opportunity for an Amazon launch would be in the UK market. In the UK, our product would be, bovine colostrum would be a food product, so there's no registration required. It is simply a matter of getting the right documentation and licenses and moving into that market. And we're exploring whether to do that ourselves or to do that with a partner. But in parallel, we're talking to people that are pan-European about getting into retail pharmacy. I think that would be a job for someone other than ourselves to go, 28 countries, a lot of countries in Europe, and other people have infrastructure in place, better place to do that than us.
Yeah. And if we just talk on the clinical trials, especially the partnerships that you have there, once you get to the end of these trials and get to a usable product, I mean, what is the outcome there with the military in terms of do they want exclusive rights to use the product for a period of time? Is there some kind of royalty that they're going to get from sales outside of sales to service members? Just maybe talk through the commercial aspect of a successful trial down the line, given that they are the kind of funding partner and you guys are, let's say, the scientific partner.
Yeah, so it's different in the case of each product. So for Travelan, it's Immuron's vaccine and Immuron's bovine colostrum product. So there's no intellectual property that the military has, so there's no royalty due to them on that. They simply want an FDA-approved product with prevention of travelers' diarrhea on the label, and once they have that, they'll start purchasing it. So that, just to be clear, there is no drug approved for prevention of travelers' diarrhea at all anywhere in the world. There's only one product which is used off-label for that, which is the oral cholera vaccine, but that's not specific to E. coli, which is the primary cause of travelers' diarrhea. So they're looking for something that doesn't exist at the moment, a preventative product. But these trials, both the phase 4 study being done by the Uniformed Services University and the phase 2 study that we've just completed dosing, even before FDA approval, we're looking to get Travelan into those documents that physicians look at when they're looking at prescribing products. So that's the CDC, Centers for Disease Control Yellow Book, which is that book that tells them which vaccines would be used for traveling to different regions. At the moment, for travelers' diarrhea, all it says is to drink clean water, wash your hands, be careful what you eat. We'd like them to say take Travelan as a preventative. It's sort of mentioned in passing in there as a bovine colostrum. It says that there's some evidence, but not enough. So these trials are about getting enough. And there's one other body, which is the International Society of Travel Medicine, which is also influential on prescribers, that we'd like to get into their guidelines, and these studies will help us doing that.
Yeah, perfect.
Sorry, I didn't answer the second part of your question. So the CAMP ETEC program, that Campylobacter ETEC vaccine was developed by the Navy, and so there will be a small royalty due back to the Navy on that particular product.
Okay. And then maybe just finally, I just wanted to talk about Travelan and the seasonality in the sales. Obviously Australia is the biggest market now with the US ramping up, but the holiday seasons are kind of completely different between Northern Hemisphere and Southern Hemisphere. So maybe if we take Australia in terms of sales, do you see more of a hit this first half coming into the Christmas period, or is it more kind of after Christmas for Australia? And then I'm guessing US is that kind of June, July thing. Is that generally how it plays out, or are the sales reasonably consistent kind of across the year, given we're back to normal travel conditions now post the pandemic?
Yes, you've got to remember that Travelan is primarily for prevention of travel with diarrhea in warm, humid climates. So it's not summer travel. Generally is not going to be the time where the product's used, but winter travel is. So in the US, so during Christmas when people head down south, to Mexico or the Caribbean or something, that's a big time of the year. In Australia, it is when people head off to Bali in the middle of our winter. So winter tends to be probably a bigger travel period where the product gets used. Spring break in the US is another one that's quite big for the same reason. People head off to Mexico and the Caribbean.
Okay, so I had the wrong way around. The two hemispheres offset each other, but it's the two winter periods that offset each other, not the two summer periods.
Yeah, exactly.
Okay, perfect. Steve, thanks very much for joining us. A lot going on, and I think we'll have to get you back in sometime in 2024 to give us an update again.
Yeah, I'd love to do that. Thanks for having me, Mark, and thanks everybody for listening. Anytime you want to follow up directly, please feel free to do so.
Thanks, Steve. If I could ask you to just please stop sharing your screen. And I know we have Amos Simantov from W2V standing by in the wings there. Amos, if you want to start sharing your presentation, I'll let you know when I can see it coming through here.
Yeah, let me share it.
It's coming up now. And yeah, if you just want to go to slideshow mode. Yep. Okay, that looks perfect, Amos. You can take it away whenever you're ready.
Okay, I'm ready. So good morning, everyone. Thank you for having me here, Mark. So W2V, we have developed in the last few years a platform for local VAT and GST refund. This is based on AI, top technology. I will go over to my presentation and then we have some questions. Let's start. So basically, W2V is an AI platform based on artificial intelligence. We have end-to-end fully optimized automated VAT reclaim. This platform is patented by AI Technologies. We have 6 different patents registered in the US and in Europe. We in 3 different families. The platform is multilingual, working on 20 different languages in 40 countries. This platform is also multi-currency one. So in the hand, we are providing one of the top platform today for VAT GST reclaim for businesses. This is a B2B. We are working closely just with enterprise clients. This is not for a consumer or for a tourist. This is just for businesses. This is one of the, I would say, the most advanced platform in terms of technology today in the market. So what we are doing, we have 3 different layers of solutions today. One of them, we call it global VAT GST. We reclaim foreign VAT, mainly for T&E, travel and expense, in 40 countries. So any country in the world can reclaim for 40 different countries. Most of them are European countries. Some of them are in APAC. So I give you an example. If you have a business and you have a global business, people are traveling to those countries in Europe, in APAC. They have their transportation costs, they have their hosting, they have their any kind of hotel cost or things like that, events. There is a VAT or GST attached to that. So we can reclaim those VAT and GST back to the company. This is a complementary and tricky, it's not straightforward. VAT and GST is not a fixed one. It's varied by different expense types. in different countries. Each country has its own regulation. You can have in one invoice, you can have for accommodation, you pay 7% VAT, and for meals, you pay 70% VAT. So you have to have a very scalable platform to address that. On top of that, we do local VAT GST for T&E. We have clients, very large clients, their employees are traveling in their own countries, and they have their own expenses, again, parking, fuel, transportation, accommodation. So we reclaim that. We find like large companies are not addressing that. They don't have the facility to people to look on those small tickets or small invoices to reclaim the VAT GST, $5 here, $10 there. So we are doing that automatically for them. So one of the example is Aviva, one of the large insurance company in Europe, based in London. So this is one of the case studies we are having. And lastly, we do AP, account payable, very large invoices for clients. This is a foreign VAT. For example, a large client that they have indoor, outdoor ads, advertisement in different countries. If they have consultants like legal one or commercial one or financial one, any kind of services they have from different suppliers between countries, in Europe, outside Europe, in APA countries, between the APA countries, from APA countries to Europe, we can reclaim this AP. So this is additional services that we are providing today. So way to that, we have today 4 main offices. London is our head of office for sales in Europe. Tel Aviv is the offices where I stay, and some of the key employees are there. In Barcelona is our company that we acquired recently. They do VAT reclaim in the Spanish market. The name of the company is Develoiva, very successful one. And we have in Craiova, Romania, an operational office. Altogether, we are about 80 employees. Market that we are addressing for VAT GST is about $20 billion unclaimed. $20 billion unclaimed yearly. This is a huge number. Tax authorities are very happy from that. We are trying to address it. We are trying to help our clients to reduce this number by providing more technology and do it more automatically approach in order to get and to gain those VAT GST back to clients. We have about 325 enterprise clients. Most of our clients are very large one. We are working today just directly. We don't have any channel or channels. It's working directly with very large one. You can see in the minute a short list of our clients. So countries that we are working daily, it's about 40 countries in 20 languages, the platform supporting that. So you can see Australia here and New Zealand, Japan, South Korea, Singapore, and Taiwan in the APA countries. We have all the European countries. On top of that, we have UK, Switzerland, we have Canada in North America, and we have Saudi, Bahrain, and Dubai in the Middle East. VAT rate runs between 8% in some of the APA countries through GST, up to 27% in the Nordic countries. So this is a huge vehicle. Therefore, we are here to provide those services to our clients. In terms of patents, we have 6 different patents protected for 20 years, 3 different families. The patents is based on the process of the VAT GST reclaim, the automation behind it, and the computer vision. We are capturing images, looking on each individual image. By that, we see the VAT rates on different items there. and from that we are reclaiming that automatically in 40 different countries with their platforms. So the way we are doing that, as I said, it's AI-based, one of the advanced technology in the world today in terms of invoices and capturing invoices and the accuracy that we are having here. So we are getting images. Once the image is received, we do image to line matching mainly for ERP system. We are getting the line item and then the image in different locations. So we do the match between the two. Then we do auto cropping for each individual invoice. Then we do the cleanup. We look on each invoice if there is a duplication, missing info, irrelevant years or irrelevant country. And then we do the validation. Once the validation is done, then it goes by 3 steps. One is claimable. So then we go and reclaiming that online. Unclaimable, so we cannot claim it. Or loss potentials. There are some invoices, if we are getting credit card slip, or we cannot reclaim that. So we have to have invoices or receipt in order to reclaim that. We are working closely with different partners in order to get the data from our clients. So you can see we can get images from computer, mobile app, and scanner. So we have partners. We are working in order to get data. They are not our channel. This is the integration that we have done the last few years with Xero, with Sage, with Certify, Oracle, SAP, Concur, KDS, and others. Once we go to all these million of invoices, we are in the range of 1 million invoice monthly, and the idea to get to 10 million invoices per month. It goes to our AYA. This is AWS system. AYA is our patented platform, automatic invoice analyzer. By that, we are analyzing automatic million invoices per month. In millisecond, we do that on each invoice, and then it goes by two channels. One is the foreign one, is here you can see it. So we are building forms per country. Each country they have their own regulation. Each country has their own language. So we are building that on their languages. And then we are submitting that. Once we submit, we get the cash for our clients to our bank account. And then we are transmitting the cash to clients, less of our fees. Our business model is rev share. So every dollar we are getting from our clients, we are taking like 20-25% out of it. So this is our business model. And then for local VAT, you see here in the bottom, we do that the same way, but for local VAT, we are preparing the report. This is going to be part of the monthly report that every company has for GST or VAT. And they can combine this report to their monthly report, and then we are placing the invoice and getting the money from the client itself, not from the government. So this is the high level of the business model. This is our dashboard. We have 20 different dashboards in our system. Everything is online. Clients can see the potential VAT and how much we reclaim, how much money they received already. So you can see it's multi-currency here. You have different years. You can see how much you reclaim, how much is in the pipeline, what was the loss potential, because we haven't received the right invoice, just a credit card slip or invoices that we cannot reclaim. So you can see it here. And then you can drill down each item or each invoice by the country, by the expense type. You can do it by per employee, per subsidiary, or per the entire company. This is a very advanced platform. I said you have 20 different dashboards here that the clients can share. This is a short list of our clients. You can see here Aviva, the largest insurance company in UK. You see TikTok, you see Pizza Hut, you see Foot Locker, eToro, Synergy, MasterCard is our client, Bank & Olufsen, British American Tobacco, Solenis, CBRE, and others. So in terms of the financial of first half 23, So we have an increase of 79% on PCP in revenue. So we are about $1.4 million. Gross profit about 66. It's about 70%, depends on the quarter around that. So we are very slim and lean in terms of the operational cost. The cost of goods sold is very limited in way to that. This is one of the advantages that we are having, and therefore we would like to leverage it better. It's about scaling and getting more data and then to get the company to profitability. We increased in transaction volume to almost 20 million Aussie. And the trade receivable, it's about 3.3 million Aussie. So you can see in the right side, the revenue, the growth that we are having quarter over quarter. So you can see also, you can see the H1 compared to H2 half year. So see first half year, 23 is higher than second half 22. In terms, this is the revenue in terms of transaction volume. There is some seasonality, so it went a bit down from 13 million to 11 million. But this quarter, we're going to show very nice growth, both the transaction volume and revenue. So we have about 325 clients. Most of our clients are in Europe. We increased that in the last 6 months and 30% increased over PCP. You can see in the last few months, clients that we signed, Ali Lilly, a pharmaceutical company, Nestle, Sony Electronics, and Lion TV, Serveo, PGIM, Maui, Securitas, a very large company in Spain, and Camper. So we, as said all the time, we are looking also for inorganic growth. So we are in a process to acquire more companies, the same that we had with Develoiva. Develoiva, it's a great success story for us. So we are looking forward to have more companies in that. We are working closely with investment banker in the UK and looking for some nice potential companies to acquire. The outlook of 23 looks very promising. Because of the seasonality, Q4 is going to be very hot in terms of revenue and increase in revenue, both transaction volume and revenue. We're going to see a very strong sales pipeline, both in UK and Spain. And the gross profit margin, we're going to see some improvement there as well. So all indication KPI, the financial KPI, we see a much better number. Although we increased the revenue almost by 60-70%, we see this trend may be higher this quarter as well. Yeah, this is for my side. So this is my name and my email. If you have any questions, feel free to ask. Thank you, guys. Mark, back to you.
Thanks, Amos. And I'd just like to give a special thank you to Amos as well, who's joining us very late in the night, early morning from Tel Aviv. So thank you for staying up first and foremost. Amos, in terms of, you talk about the 325 enterprise clients and a lot more that you're in discussions for. In terms of assessing a client that you're trying to engage with, or the sales guys in London are trying to engage with, are they looking for, is it number of employees, the revenue line where you can go backwards and say, well, their VAT claims must be X. How do you kind of sift out to who an ideal customer would be to engage with?
We are addressing companies with a size of minimum 1,000 employees. In average, we are about 5,000 and up, with a revenue of $1 billion. This is the minimum for us to look for enterprise clients. By the way, I haven't mentioned, but we are about also to announce a first client in Australia. We started looking for clients in Australia as well, so we have some activity here. It looks promising. Very large corporates that we started to present the platform, and the first will come soon.
And then in terms, that's a good segue maybe into my second question. In terms of you bring on a new enterprise client. We'll take the Australia one for an example. In terms of the improvement levels that they get in VAT refunds, whether that's locally from international travel or whatever, maybe just give us a sense of, what the kind of average uplift or the average return that they're getting from, using W2VAT. Do they see a 3% increase in VAT refunds or 5% or whatever the number might be? I'm just trying to get a sense of, the return on investment from engaging W2VAT if I'm the, CFO of Nestle, for example.
You can find different companies with different solutions. Some of them are not reclaiming at all, and this is a green field, and this is great for us. And there is few reasons for that. They don't want to. They think that it's cumbersome, bureaucratic process, so they are dropping that, and they think it's a small money. When we are doing this exercise, we're showing them that they potentially can get few $1 million easily. And there are companies are doing them by themselves, so it's a very limited unit doing that, and mainly manually. So then when we are coming in, we are showing the technology, it's 3-4 times more than they can do manually. And they are doing that with our competitor. When it comes to competitors with our technology, we are showing an increase between 30 to 40% using our platform.
Okay. And in terms of, I know you had the list of countries there. I noticed the US was missing off the list. Is that due to, the US system with sales tax, and a whole load of other taxes, different per state? Or is it, just the opportunities you've had in Europe to date?
It's a regulation. Yeah, it's a regulation. Sales tax in the US, it's not a federal tax. Therefore, you cannot reclaim it. But US companies that are having business in Europe or in APAC, they can reclaim their VAT there or GST there. But if Australian company, if they have business in the US, they cannot reclaim the sales tax there.
Okay, so it's a function of it, because I know Lilly was on your list there, so I was just interested in that. Being a US-based company, that
you can find big countries like China is not there, and India is not there, and Russia is not there. So first, you cannot reclaim with them because their regulation. It's not because of us, because if they've been potentially providing that, then we will be the first guy jumping in order to reclaim that. But it's a regulation issue.
Okay. And in terms of the revenue model, you said it's a complete, it's a revenue share base. So, if you get an extra 10,000 back for them, you guys are taking 20 to 25% of that. Is there any platform license fee that goes along with using your system, or is it a pure revenue-based model?
Purely a revenue-based model.
Okay, perfect. And then my next question, in terms of the pipeline for the enterprise clients, is there a portion of that where you're working with, say, the European arm, but they've got, a complete separate Asian subsidiary that, kind of runs itself, but, they're going to now start using W2VAT? Or, when you take on a client, is it basically, doing their worldwide, given the size of the operations, they're kind of worldwide stuff. So whether they've got an Asian subsidiary that looks after APAC, the European head office looking after the European business. I'm just trying to get a sense of, is it clients, or is it expansion to different divisions?
Yeah, it's varied between clients. Some clients are saying contract is worldwide, and you are getting all their subsidiaries around the globe. Some, you can reclaim, and some not. And there are some clients saying, okay, let's start with one subsidiary, one company in Europe, then we will expand it gradually. So it's case by case. We are, as a company, are pushing to get the entire business. But, some companies are more conservative. It's mainly those that are greenfield. They would like first to see how it goes, and then they can give you the green light to expand it.
Okay, got it.
But most of our clients, I would say, they are running with us in the last 5 years. It's a worldwide agreement.
Worldwide agreement. Okay. And in terms of acquisitions, I know you said you're on the lookout for more after completing the recent Spanish one. Is that to get you into the customer bases in a particular country? You know, so somebody who's competing with you, but they're very strong, I'm going to say in the Swedish market, for example, or the Italian market, or are you also looking for businesses that have some technology angle that would be a good fit to, you know, enhance your platform? Maybe just give us a sense of what you're looking at on the acquisition front.
Then we are looking for revenue and scale for us is large clients, and in the end we are looking for companies that have their own clients, very large one, that we can integrate them to our platform. So this is the idea. Most of them are they have entry-level technology or solution, and we can provide our platform and can get their clients and their services to different level, and also decrease the cost of the operational part by doing that more automatically.
Okay. And in terms of the sales cycle, I know you talked about the Australian client that you're currently talking to. In terms of how long we should, you know, think of that cycle from first engagement to getting the platform up and running with the finance team, and the kind of first flow of transactions through it, and you know, revenue to you, is that a 6 to 12 month type cycle? Is it a, you know, 12 to 24 month type cycle? Because I can imagine, you know, trying to get in front of the CFO of Nestle or somebody who can actually make a decision can be quite an extended process.
Yeah, the sales cycle is typically enterprise client can run between 3 months to 9 months. The onboarding can get in our platform up to 1 month, so it's very fast. And then we can start getting revenue out of it. Okay. So this is the process, more or less.
Okay. And the seasonality you talked about in the business, I just want to touch on that for, you know, given you cover such a, you know, wide variety of markets from, you know, Japan across all the way to Europe. Just kind of what drives that seasonality? Is it just one or two particularly large clients within the mix, or is it just, you know, you're kind of more heavily weighted to Europe versus let's say APAC at the current point in time?
The seasonality comes by the regulation. There are some deadlines that you can submit VAT, and therefore, so end of Q2, there is a deadline there, and end of Q3, there is deadline there, and then end of the year, some of the companies, their financial year is end of the year, so they are pushing to get their money back. So there are 3 quarters that are quite hot, and the Q1 is the slower one. As long you proceed with the year, you can see the growth. So from Q2 to Q4. So yeah, this is our life.
Okay, so it's way ahead to the if we say to the calendar year end in terms of seasonality, given yeah, I'm guessing most countries in Europe
And you
follow
have deadlines
tax
in
year.
countries. If you are missing the deadlines, you cannot reclaim after that. So you should be you know, on top of the deadline, and you see that you are getting all data and you're submitting end of Q2. Otherwise, if you miss it, you miss the money.
Okay. And in terms of I guess partnerships, you know, you have Sage on there, and Zero and a few others. But a lot of these guys are running, you know, huge ERP systems, whether that's, you know, SAP or Oracle or whatever. In terms of integrations into those systems, the Oracles, the SAPs of the world, where does your system link up there? And are you, an approved partner or an integrator within those large ERP systems?
Yeah, we have API integrated to their platform. So once we have clients, we are using our API or their API. So this is the way it works. We don't have partners are promoting our product yet, because we are enterprise. Our business model is based on enterprise, very large clients. You need to approach them directly. We are probably will announce another product will get us with some cooperation with different partners. But the bread and butter of enterprise is a direct approach. So this is what we are doing daily.
Okay. But yeah, my kind of question was, it doesn't matter if somebody's running SAP, somebody's running Oracle. It's you're agnostic to which one they're kind of operating on.
Yeah, we already developed the connector, so it should be straightforward.
Okay, perfect. Amos, we're going to leave it there. We're just up on time, and I do appreciate it's very late on your side. So thank you very much indeed for joining us.
See you soon. Thank you.
So if I could just ask you, please, to stop sharing your screen. I do know we have Sam Riley from Ansarada standing by in Sydney. Sam, if you want to start sharing your screen. Hello, I'll let you know once it's coming through. I want to say, while Sam is getting this up, welcome back to Sam. It's been a long time between drinks, so I'm glad to have him back on to give us an update on all things Ansarada.
Thanks for having us back. What I was going to do is just explain what Ansarada does and how we've been trading, including recently in October, and just talk about our strategy, and then take some Q&A, if that sounds all right.
Yep.
Yes. So I'm one of the co-founders. The name Ansarada comes from 4 founders. It's Andrew, Sam, Rachel, and Daphne. It's our first 2 letters, if you want to figure out the name. The reason we exist and where we operate is we work with information and processes, and quite critical ones in business. So mergers and acquisitions, due diligence activity, procuring high risk, high value infrastructure, companies that have to do governance, risk and compliance activities, etc. And our mission is to help bring order to the chaos that they face. So a lot of people run critical business processes and outcomes, like I just said, using spreadsheets, email, multiple different storage methods. So they really have a lot of chaos and no real visibility and control and efficiencies. So that's where we apply our craft. Because when information and processes are structured correctly, organizations get more insight, confidence, they reduce risk, they can make better, quicker decisions, and they achieve better outcomes. We're a great place to work for the last 13 years, often in the top 10, top 20 places in the country. We really live out our values there, deep care for all our stakeholders. We could ask ourselves, how would an investor care about this decision? How would a customer care about it? What about the team? Really a lot of care drives what we do. We are change makers, so we have to be courageous, very curious, and we want to see positive change. So, if you don't know Ansarada's products, on the right, we do have a product for deals, like helping people prepare all the information and get ready for capital raising, M&A, debt refinancing. We also do distress deals, like corporate recovery, insolvency, bankruptcy, those kind of things. Anything where you've got critical information that you want to share with external parties in a secure way and track everything, manage the questions that people have coming in on your information, like a bidder or an investor, and then disclose answers to them and have it all buttoned up. Our Procure product, I'm going to take you through all of these later. That's for roads, ports, rail projects, multi-billion-dollar, high-risk, high-value infrastructure procurement. So people that are going to tender for those jobs, they have to get disclosed a lot of information. There's a lot of accountability often on the government to make sure it's a fair and equitable process and everyone had the same access to information at the same time. So our product provides audit trails and proof of disclosure for that. Another product that we bring order to is around risk and compliance activities and governance. And we recently launched a product for managing ESG because that's another chaotic process in business. So we've been around for like 17 years. Many of the world's top companies, banks, law firms, accounting firms use Ansarada. We've got thousands of those advisors around the world that constantly refer us new business into companies. 600,000 users. We're very well-established, trusted brand when it comes to critical information management and high-risk transactions. Just a quick recap on what we did in FY23. We are trading profitably. We have great free cash flow and zero debt. So we actually increased our margins in FY23. We are a growth business, and each of our products is at a different stage of its life cycle, and we're investing differently into the growth. But we were really happy with the environment. We're happy with how we traded in the environment last year, because I'll take you through a slide that highlights just how tough the macro environment has been on deals. So you probably know there's a lack of IPOs, M&A, cap raise, but we performed really strongly. And if you look at how we traded in Q1, from July to September, we actually increased our margins. Like we're now 22% EBITDA margin. We were positive cash flow from operations, maintained zero debt. And that was quite good because the previous year in Q1, we actually burnt through a few $1 million because we got a lot of one-off seasonal payments that come out in Q1 for us. So this year we still had those one-off payments, but we were able to more than cover them and generate free cash flow. The bottom metrics there, we've got a lot of growth in our ARR revenue. Deferred revenue, 18.6 million. If you don't know what that means that's future revenue that we've billed it. We build that revenue. It might be a 12-month contract. Say it's $12,000. We account for that $1,000 a month, but there's obviously deferred revenue. So it's future revenue that will be counted. So the higher the deferred revenue balance, the more certainty around future revenue. So that's really good. And our ARPA is our average revenue per account. So that's $1,400 per account per month. That's a monthly figure. So that's an 8% year-on-year growth. So our average revenue per customer is going up as well. And we have seen a slight decrease in subscribers because the bulk of our subscribers are from the deals environment. But I'll show you how we've mitigated that stuff. I do want to stress one of our big goals is around generating $100 million in annual recurring revenues. Once upon a time, Ansarada was purely a transactional in and out product, and our revenue model reflected that. But a few years ago, we started, architecting and concentrating on building ARR. Pleased to say that grew 42% year on year. It's now over 12 million, but in FY23 it was 11.4, and you can see the split where it's coming from. 6 million from our deals product, 3 million from GRC solutions, 2 million is ARR from procurement customers who standardize all their procurement activity on our platform. The New South Wales Department of Transport is a classic example of that. So like I said, we've got this ambition to get to 100 million ARR. On the left, a few years ago, we put in the foundations to do that. So we put in a lot of product-led growth methodologies, digital channels to market. We build up channel partners. And we also invested a lot in the product capability to generate ARR. I would say we're 80% done on foundations, but we're much more squarely now in that expansion phase. We do have the multiple products. We do have the connectivity into the CFOs, CEOs, general counsels, and the C-suite that use those products, and they have those problems every day. So we're scaling the channel partners. We're rapidly developing our ESG and GRC products, and we're scaling our procure business across the globe. So our next target milestone is to get to 30 million in ARR, and that's what the team's concentrating on. So won't spend too much time on this, but everyone's probably familiar with, you read the fin review around this merger and this acquisition, or these people raise this capital. So we have thousands, like 10,000 customers that use our deals product. And like I said, the law firms, banks, accounting firms, corporates, anyone doing Series A capital raise, all the way through to, Newcrest and Newmont acquisitions, mergers, all of that stuff. So that product is a very mature product in the sense we've been building it for 15 years. It's bulletproof. The more complex the deal, the more information, the more risk, then the better our product is. We put in several AI tools in there that will predict better behavior and outcomes. We will automate a lot of activity. It's just a product that we're the world leader in, and we get revenue from 180 countries from that product, and including $6 million in annual recurring revenues that we generate from customers that have a lot of deal activity. So you can imagine like Charter Hall or Dexus, Google, these are customers of ours that do repetitive transactions, and they standardize on that. It is worth showing you this graph because investors a year and a half ago said, gee, you guys are going to be in trouble with the global downturn in deal making, right? So, inflation, interest rates, uncertainties, pandemic, all of that stuff. People thought Ansarada's revenue would go down because you can see here there was a 4% decline in global M&A deal volume. But over that period, we actually grew our revenue 66%. That's because, I'll take you through it, we've got a lot of non-deal revenue. We've got a subscription model, and we generate ARR. And we also generate revenue from distressed deals as well, not just what I call good times M&A deals. So the Ansarada business, we always knew it was very resilient, but it's been great to prove that on market. Since we listed nearly 3 years ago, we've consistently overperformed what we've said, and this is a very good evidence point. I did say I'd give you a recent update. We were quite excited by October trading because that was a record month for us in terms of revenue. The biggest decline we saw in deal volume was from Europe. So we've seen that recover, and now it's 105% up on the prior year. And, we took the opportunity in October to tell the market, we're still positive free cash flow. It's not a problem for us. You can see the chart on the left. You can see the yellow line shows the decline in the global M&A deal volume affecting us. This is showing our new subscriber wins. So every month we have new subscribers come in our product, but the volume of new subscribers from July 21 to January was 2023 was declining. But it's great to see the methodical uptick in volume and new subscriber wins. So the market's still pretty flat for M&A deal volume, but we're actually winning more subscribers. So 13% up year on year. And October this year was materially higher than October 22. So that's a good sign for the future. I just want to go through a few of the products, just if you don't know them, because I do know if you don't work in the industry or use our products, it might be, I don't even understand what Ansarada does. Can you please let me know? So like I said, if you're procuring like roads, ports, rail, energy projects, batteries, wind farms, hospitals, you know, anything that requires a lot of information and process to put out tenders and then have people go through the tender process, be evaluated, and then ultimately awarded a contract. It's very high risk. There's a lot of sensitive information to protect. There's a lot of pressure with time and stress, and then they want a product that's just designed for that workflow that needs to happen. So we crafted that for seven or 8 years now, and that's a world-leading product. We're actually expanding and winning business in Canada, the Middle East, South Africa, Europe. So, and there's a massive amount of projects we're positioned to win in Indonesia. There's, you know, more than $100 billion worth of infrastructure renewal and new projects kicking off there. So that's our Procure business, got a dedicated go-to-market team, its own P&L, and it's run semi-independently from our deals product. And, you know, those guys have a massive pipeline that they're growing. Governance, risk and compliance is where, you know, companies typically manage, they either don't manage risk at all, but when they get a little bit bigger, say 20 million in revenue, they start to manage risk on spreadsheets and email, and it becomes disjointed. And then after a while they go, this isn't effective. We don't have a good risk and governance system. So that's where, you know, we have a SaaS product that's designed to allow people to put in their policies, capture all their risks, who owns the risk, what is our control for this risk to manage it, and how effective is that control. And, you know, if you're into risk management and governance, you'll know what I'm talking about. But just like you couldn't manage your HR team on spreadsheets, there's HR software for that. You wouldn't manage your sales team on spreadsheets. You use a CRM system. It's the same thing with risk and compliance, because there's certainly not less risk and less compliance on companies. There is more. And if it's not done properly, it's chaos. So that's where we bring order and structure and confidence, which the board and the management team like. So that business, we acquired that business a couple of years ago. It was doing 2 million in ARR. Now it's up over 3.5 or 3.3, and it's growing. We've invested heavily into it with product and R&D. We've launched a game-changing piece of software for operational resilience. And you might ask what that is. It's like, well, instead of being reactive on risk, these days people should be proactively running scenarios that could impact their business and identifying exactly what services and people would be disrupted and how would they mitigate that. So you think about a pandemic scenario, a fire, flood scenario, a cybersecurity scenario. There's a whole load of different scenarios depending on your business and industry that you must be operationally resilient against. It's actually in legislation for the financial services sector. They have to comply with that, and that's cascading down to other industries and businesses. So we've positioned ourselves as an operational resilience leader with a brand new SaaS product that's a game changer for people there. And that's going to be a big growth product for us over the next few years. Lastly, our last product suite is around sustainability management, or environmental, social governance issues. There's regulation on companies in Europe where we operate that we've targeted this for, but it's also cascading into Australia and other territories. Essentially, companies don't know where to start here. There's a sea of acronyms and confusing regulation and standards. So we partnered with experts, digested all of that stuff, and created a SaaS product that helps people put together a strategy, set up their metrics and targets that they want to improve across the various issues and opportunities they have, implement the proper risk management, and then evidence and mature their governance practices as well. And those 4 things are actually what all of the sustainability standards and regulation vector back to. They just ask you to establish those 4 things, and they prescribe some ways that you should do that. And to date, there's no SaaS products that actually walk people through this step by step in a simple way. So that's why we brought that to market. We originally launched a gap analysis tool and a benchmarking report. We made that free. It takes 10 minutes to do. We've got 500 people that have signed up for that. And then the next set of products for strategy and metrics, we've now got several customers using them, but we have a major release coming up in March. And basically this year we want to get a solid growth funnel going on that product, so that in FY25, next financial year, we can really put the pedal down and scale this globally. But as you heard, Ansarada has a lot of connectivity into the actual users who want this solution. And given we already had 500 sign up for our first product, we're quite confident in its growth. I should mention actually that 500 that signed up were just out of our user base. We didn't spend a cent on marketing to acquire those 500 customers. So because of our user base is the C-suite, we've gone to them and said, hey, what are you doing on sustainability management? Is that a chaotic problem for you, or have you got that under control? And I don't think you'll find a CEO or CFO that say, oh no, we've got that under control. It is chaos. So there is demand for that solution, basically. Our key priority areas to keep executing our strategy, keep building ARR. We've got that massive funnel of freemium customers. We believe that the best way to sell your product is to be transparent and confident in the product actually solving the problem for the customer. So you can go online at Ansarada, sign up for any product for free. Once you experience value in that product, then you can convert to a paid subscriber. So there's a big funnel of customers to convert. Like I said, we want to establish and expand the ESG and GRC products. And our next milestone on ARR is 30 million from the 12 to 13 that we're doing at the moment. We've got good renewal rates as well, so it gets a little bit easier to build that ARR, but we're focused on that. A big part for us last year, you've seen our margins increase from a 16% EBITDA margin to 22%. A big part of that is because we're quite obsessed about operational efficiency, and that often results in a much better experience for the customer as well, because it's less friction for them and us, and so it's a win-win. And as I said, we've been self-funding our growth strategy, and we aim to keep doing that. When we do see large growth opportunity, we will invest into it, but we're really big on making sure that our growth funnels have the right metrics and the right customer acquisition cost and payback to expand. So that's Ansarada in a nutshell, bit of an update. So over to you, Mark.
Thanks, Sam. Maybe first question is the increasing average revenue per user that you called out in one of the slides. Is that coming from price rises coming through the system, or is it more coming from the mix between deals and procure, for example, where I'm not sure if deals procure has kind of a higher cost per user versus deals. Just where are you that increase in average revenue per user? As you say, the M&A thing, which is the kind of main driver in deals, is kind of in a low point in the cycle, but I'm just interested at how you're driving that.
Yeah, good question. That number, that's our average revenue per account. So it does not include the procure business, because the procure business is high value but low volume in terms of the accounts. So the average procure contract could be 40,000 to 1.5 million. So it's quite a range there. So it's large because of the volume in our business. The average revenue per account mostly comes from our deals business. So what we've seen is we offer the market different purchasing plans, like a 1 month plan, 3, 6, and 12. So we've seen people opting in for shorter durations, but their actual deals take longer to complete. because there's a lot more diligence activity, there's a lot more cautiousness in the market. So when they do that, they end up extending their contracts, and often for multiple years actually. But that's driving it a bit. We did do a price increase in October, but that number I showed you has nothing to do with that, because we only did a price increase for new customers, like for new accounts signing on. So we will see a continued growth in that average revenue per account from that price increase, but it was around an 8 to 12% increase depending on the plan and the product. But we think that's going to just tick up our average revenue per account over the next 12 months as it works its way through the system. But yeah, so that's largely where it's coming from.
Okay, we've got a
right. The other one I would say, we do have more customers that are using multiple products. So they might use our deals product, but then they sign on for the GRC product as well, or they upgrade. Yeah.
Okay, perfect. Question from the audience: operating leverage in the business. Maybe if we look 12 months out or 18 months out, if we get to a better point in the cycle from M&A wise, the question is around capacity to handle, if we get back into a strong M&A environment, IPO M&A environment. Have you got kind of the workforce in place, or I guess the capacity to deal with the rebound when it comes?
Yeah, we've never been in better position there, because one of the operational efficiency things we did is, a lot of our customers are very familiar with deal making, and Ansarada's their chosen platform for several years. So they're very used to using our product and they know what they want. But if they're an advisor, they often get a quote for their client, and then their client signs on, and then they, log in our data room and start doing their activities, right? We used to, and our competitors still, only have a direct sales team. So it all had to go through a person, and every single deal took about 6 hours to do the contract and negotiation and provision our product and send them a login and all of that. So over the last 2 years, we completely digitized all that. We made it like less than a minute to sign up online and get going. As I said to you, we say, look, it's free to start. You only have to pay us when a bidder logs in. So we removed all the risk for them. So in October, actually close to 70% of our deals revenue came through the digital channel that we established. So it's highly scalable and fully automated, and it doesn't require us to invest into headcount whatsoever. If we were to double the volume there, it would just be fine. We'd probably have to hire a couple of people in customer success and that, but our gross margin's 94% because of the digitization of deals. Yeah, we would welcome any uptick, and that would flow straight to the bottom line.
And then just touching, you mentioned there in your answer, the channel partners, in terms of working with them, incentivizing them to use your, whether it's deals or procure maybe to this, or GRC even. I'm thinking of the law firms who are dealing with, or the corporates as well, dealing with potential deals on one side of the business, and general counsel side or general board stuff on the other side. I mean, what do you offer them if I'm Herbert Smith Freehills, for example, that I'm only going to use Ansarada for any deals that come through the door in our kind of corporate advisory business, as opposed to using a competitor, or just using some system that they've kind of used historically, whether it's been inbuilt or not?
Yeah, well, the number one answer is the best product and service to actually get the job done. Like in Herbert Smith Freehills is a good example. They're a premium brand. They're a very high value law firm. They do great service. So they primarily will make decisions based on what's going to give their customer the best experience, and also what's going to de-risk the deal process. So they will look at our product and its functionality and evaluate us against other people on that primary basis. So that's one. The second thing is, instead of procuring products deal by deal and having Ansarada on one deal and another platform on another and another platform on another, if advisory firms do that, they can't standardize their own operations, and that they actually have a lot of junior lawyers that do a lot of the activities in our product. But if it's completely inconsistent, like the training, the onboarding, and the risks that they take goes up. So what we do increasingly is we've got a lot of templatization for different deal types, like capital raising, strategic review, M&A, that they can load up into our system, and they've got their own templates around exactly how they want to kick off the deal, what information they need, who needs to get it, when is it due, and then we embed ourselves in their business like as an operational tool. And the third thing we do to incentivize that is we say, hey, listen, you're coming to us roughly doing 26 deals a year, but every time you come, you're paying our singular deal price. Why don't we sit down and talk about an annual agreement where you could do up to 30 deals, and we can give you an annual subscription, and that is a lot more cost effective for you. We get the certainty there of not having our competitors in and out, and we embed ourselves with the client. And we found when we do that, like we did that with Grant Thornton years ago, when we did that, they actually expand the use cases for Ansarada. So GT will use Ansarada for their valuations work. They get involved in forensic matters with their clients, like forensic accounting and sensitive matters. So they will deploy our product for that. So that's the third thing, is the incentivizing them with an annual agreement.
Okay, perfect. Sam, we are just up on time here now, and I do know our next presenter is standing by. Thanks very much for coming back and giving us an update on all things Ansarada.
Thank you. Thanks a lot.
And
bye.
Flip now from Sydney down to country Victoria, and I'm welcoming back Dr. Chris Richards from Apiam. Chris, or Catherine, I'm not sure who's sharing the deck. Yeah, I can see it up on screen now. Chris, you can take it away whenever you're ready.
No worries, thanks, Mark. And so today I'm just going to provide an overview of the company's activities, our year-to-date performance, some updates on our strategic direction before just covering off on the outlook for the group. So, yeah, I just want to start this morning with a reminder of where the Apiam business is positioned today. So if you remember back at IPO in 2015, we were predominantly a veterinary business providing services to the intensive animal industries, being pigs and beef feedlot, and with a small number of dairy and mixed animal clinics. And we had about 25 clinics at the time. If we look now where we are, we operate 80 veterinary clinics. We've got 365 clinical veterinarians. And there's been a real change in the makeup of the services and the species that we're providing, veterinary services to. So, we now have over 83% of our dairy and mixed animal clinics that generate over 50% of their revenue from services to pets. And so that's really been driven by a couple of things. One has been, obviously, during COVID, there was a significant increase in pet ownership across Australia, went from 61% to 68% of households got a pet. And the second part of that is that, between 2020 and right through to the first half of this year, we went on a fairly aggressive acquisition program, predominantly acquiring clinics that had 50% or more pet ownership. And so what that really has, turned the company into now is a business where 80% of it is, or 79% of it is very resilient and fairly non-discretionary revenue. whereas the other 21%, which is in feedlot and pig, still a very important part of our business as we provide a full veterinary offering to rural and regional Australia. But that's more a bit more cyclicality in that part of the business, and it's now at 21% of the business. So maybe just giving a bit more detail on what those two segments look like. So the mixed animal and dairy segment, which includes dairy, companion, some of our pasture-based services, as well as our equine businesses. You know, these are your typical vet clinics that are located in regional cities and towns. We've also got some doing 100% companion area animals in peri-urban regions just out of the capital cities. So they're pretty well, you know, typical what you'd expect in a city veterinary clinic, except for the vets are also going out into the field to provide services to large animals, to livestock. So in these clinics, you know, similar to city-based companion animal clinics, we're offering wellness program called Best Mates. I'll talk to that in a minute, but that's a significant uptake. And then we also have service programs such as our Pro Dairy program, which has now got over 20% of the dairy industry on that program. You know, this business segment is predominantly services, but there's also products associated with you know, prescription animal products, some of the OTC retail products, but then also a lot of diagnostics and pathology services as well. So very, very resilient part of our business. The other part, the beef, feedlot and pig segments, this is where we're providing consultancy advice, but the majority of the revenue is coming from product sales. Over 90% of the revenue in this segment comes from product sales. So these are vaccines for preventative healthcare, some of the prescription products, as well as other products that we've developed that improve livestock performance. In addition to that, we operate a diagnostic lab and a vaccine production lab where we can leverage those services and products across our existing and growing business. So I'll drill in a bit more on the first 4 months of this year. So this is, you know, trading into FY24, and you'll see from the business, you know, following what has been a very aggressive acquisition program over the last few years, we're now starting to see early signs of really being able to, you know, starting to leverage the earnings from what was a very aggressive program. In the first 4 months of this year, we had 14.2% growth at a revenue level, but you'll see that we had 17.2% increase at gross profit. So we are getting margin expansion. We're getting margin expansion because you'll see that we're increasing our average transaction value, but we're also growing those parts of the business that have a higher gross margin, being the companion animal services in our equine business. That's starting to flow down to the bottom line, and we've had 19.6% growth in our underlying EBITDA and 15.9% in our underlying EBITDA. So yeah, so we're really in the early stages, but we're seeing some great results starting to come through as we focus back on our clinics and really drive organic growth and get more efficient workflows and start to leverage our earnings. So that growth at the moment is really being driven by the dairy and mixed animal segments, as well as a rebound in the beef feedlot segment. So, you know, what we've been doing is not just increasing our revenue, but we've had a very high focus on operating expense growth. And in fact, to the level that we've only had 0.6% operating expense growth in the first 4 months on a like-for-like basis, which is we think that's a pretty strong result considering the inflationary environment that we all operate under. In June of 2023, we undertook a restructuring and redundancy program. We took $2.6 million out of the business on an annualized basis, and that's starting to flow through into these results now. But as I said, there's also additional opportunities to increase our margin performance of our clinics as we progress through FY24. I'll now just drill in a bit more the first 4 months on the dairy and mixed segment itself, and on a reported basis, it's had 18% revenue growth. This has been from the contribution of acquisitions as well as some organic growth. On a like-for-like basis, it was at 1.7%. And you might say, well, that's a bit soft compared to where we were last year, because in FY23, we delivered a 4.6% like-for-like growth in this segment. But, when you think about the growth that occurred during the COVID period, as well as where those animals are in their revenue, the revenue life cycle part, then it's still a very strong result compared to industry. And when I talk about the life cycle of the animal, down the bottom right there, you'll see that most of the there's certainly a high level of revenue that happens in the first year of a puppy, for example, where they're getting vaccinated and desexed and other procedures. And then in years 2 and 3, that drops, potentially up to 40%. And they're the years that we're currently in at the moment. So, based on, and that's really what we're seeing that's happening across the greater industry, but we're not seeing as great an impact in our performance. What's positive is over the next 5 or 6 years, that rebounds very quickly, as in year 4 to 5, dogs need to come into the clinic a bit more. They're starting to have some of the more higher cost procedures that occur, and that'll continue to go as they get into their geriatric years. If we look at how we're driving increased revenue despite a slowdown in some of the traffic because of that life phase, well, it's around our average transaction values. So the top right graph there, you'll see that since 2021 we've had a significant increase in our average transaction value, and for the first 4 months of this year, it was up 11.2% compared to the same time last year. And so, part of that's pricing, but a lot of that is around actually just capturing charges for the things that vets are doing in the clinics. And that's because, we've been implementing a new platform where we can capture those charges. And we're also training up our vets to be able to provide the higher standards of care. When it comes to our wellness program, our Best Mates program, we've had 17.6% growth in the first 4 months. So, some of that's organic and through our existing clinics, and some of it's by putting that Best Mates program into some of the acquisitions. On the dairy side, which is a business where we haven't made any acquisitions in the last 18 months or 2 years, we had 20.7% growth in our services into the dairy industry through the Pro Dairy program. So, where we're really focusing on organic growth, we're starting to really deliver that. And as more animals come in as part of the life cycle, then we expect that to continue to grow. In addition to those organic growth opportunities, obviously we're also, as I mentioned before, really focusing on the margins in the clinics and looking at the operating expenses, but more importantly, looking at workflows so that they can be more efficient in the clinics. The other segment in our feedlot and pig segment, this has been fairly challenged over the last 2 or 3 years. So in the feedlot industry, there's obviously with 2 years of exceptional rainfall, the cattle herd bred up to its largest cattle numbers in, I think, about 20 years. And so as a result of that, there's less cattle to go into feedlots. At Apiam, we make our money in feedlots predominantly in the first 30 days through when feeder steers are coming into those feedlots and they need to be vaccinated, or they tend to have health issues in that first month. So that business is really driven by the number of cattle that are coming into feedlots. Obviously, El Nino is now kicked in, and we're seeing more cattle start to come into feedlots because, again, with that larger breeding herd, there's a larger number of progeny that need to go to slaughter. So you'll see in the graph there in the middle at the top there, the change that's starting to happen. So, in September and October this year, we've had significant increase in our revenue compared to the same period last year. Year to date, October year to date, there's about 9% growth, and that's sort of where we're expecting that'll continue into the second half of this financial year and the year after. In terms of what's happening behind the scenes, if you look down bottom left on that national adult cattle slaughter graph, MLA, who across all the numbers are really putting out some indicators of expecting that that cattle numbers will slaughter numbers will continue to increase. So it is looking fairly good for the industry over the next 1 to 2 years. Cattle prices have been decreasing, which is good for our clients buying feeder steers, and there's also been some reported increases across some of the export markets. So yeah, it looks like our feedlot business is starting to rebound. The bottom graph there, cattle numbers on feed, you can see the history over the last 25 years. That industry, yeah, it is does have some cyclicality, but it does continue to increase. And at the moment, the feedlots are about 80% full. So there's certainly capacity there to take in additional cattle over the next couple of years. Our pig business has been recovering from the second half of FY23, where Japanese encephalitis occurred in that early period of 2022. So for us, we're really trying to focus on providing higher value veterinary services. We've got some new products that we're bringing to market, and that's where we expect the growth to be there. So yeah, really positive in that in FY24 year to date, we're at least getting some back to some like-to-like growth. Our acquisition program. So as I said, we went through a fairly aggressive acquisition program through FY22-23. We've acquired a couple of clinics in early of FY24. What's really pleasing to see is that we get really good synergies from these acquisitions, and those acquisitions that we've made in FY23 and FY24, we had 7% average revenue growth under the management of Apiam compared to the same period when they were privately operated. So how do we get that growth? Well, we align prices. We bring our programs such as Best Mates into those clinics, and that's where we're starting to certainly get the revenue growth. The area that we're focusing now is around cost synergies, so that we can again start to improve clinic earnings and get them to where our group targets are. As I mentioned the other day at our AGM, our intention is really to focus on the existing clinics that we have in our business. And so we went through a very rapid acquisition program, and now we're really focusing on leveraging the benefits of that scale to the company. So we have no intention of making further acquisitions, certainly in the FY24 period. We've also been building some new clinics. We built 3 greenfield clinics in FY23 in these peri-urban regions, in these growth corridors around Brisbane and Melbourne and Geelong. And so they've been going along fairly well, particularly in the last 18 months, where we changed the model to change the ramp up model so that we could really manage the impact of the first year's trading and its impact on EBITDA. So we're very happy with the way those clinics are performing now. We're getting very experienced vets coming into them, which is getting them to break even within 12 to 14 months. You'll hear a lot in the media around veterinary workforce shortage, and certainly in the peak of COVID that was occurring. We seem to have, it's certainly for us, it hasn't probably had as bigger impact as what may have happened in other regions. And I think there's a few things that are really contributing to this, because if you look in FY23, we actually had a 15% net gain in our number of veterinarians, excluding the acquisitions. What's happened in the last 6 months, though, is that whole labour market's changed even more favourable for us, and we're now being able to fill a lot of the positions that we hadn't been able to fill. In fact, we're even in a position now where we're able to choose which veterinarians that we want to bring into the business to ensure that we can bring in a lot of highly skilled vets that can generate revenue from day one. So what is it that's enabling us to attract vets? Well, it's certainly our flexible workplace practices. They're certainly having a big impact. We have over 80% of our veterinarians that are under a flexible workplace program, with a lot of those working a 4-day week or a 5-day fortnight. If you look to those charts over to the right, the reason that I think we've been able to really leverage that those 4-day weeks and 9-day fortnights is because those veterinarians are working full time. And if you look at Apiam's veterinary workforce, 66% of our vets are working on a full-time basis, although it may be over a 4-day week or a 9-day fortnight. Whereas at industry level, it's only 50%. So, obviously we can get more hours out of the number of people that we have in the business. And we think that it's our, the practices that we're offering that are really contributing to this. When you look at our female workforce, which 72% of our veterinary, workforce are females, they're also, you've got 63% of our females who are working on a full-time basis. And so, what we're doing around the flexible workplaces is certainly working. Some of the other initiatives we're doing, we've created a Your Vet Career Your Way, not just focusing on career development, but also lifestyle choices and that work-life balance. And so that's enabling us to attract vets. We also operate a tele-triage service after hours. So, in cities, when vets go home, the animals can go to an emergency centre. In the rural areas, we have to do our own after hours work. So being able to screen those calls so that vets are only called out to emergencies is really important from a work-life balance point of view. And our team of triage nurses are reducing weekend calls and after-hour calls to vets by over 70%. We also offered a student debt reduction program. Student debt is a big issue, as you're probably aware, across a lot of industries. We launched that earlier in the year. It closes at the end of the month, but we've already made some appointment to some high caliber applicants. So from a vet workforce point of view, certainly changed dramatically in the last 6 months, and it's really going to give us the ability to capture some opportunities that in previous years we may not have captured. Our growth strategy, I'll just talk to this briefly, but there's 3 pillars to our growth strategy: people, customer, and community. On the people side, it is the real base of our business. As I said, not just in terms of recruiting and retaining veterinarians, but we really invest in our people, particularly around ongoing learning and development, and their health and well-being. From a customer point of view, we're introducing new services, starting to introduce some new technologies, as well as changing workflows through team-based consults, where we can use non-vets to do things that vets traditionally have done, but legally really don't need to do. From a community point of view, we're really invested in our local communities. So not just through supporting community groups, but actually being active participants in our local community. And that really enables them to be brand ambassadors for the company. So in terms of outlook and looking ahead to FY24, our revenue opportunities remain strong as demand for non-discretionary veterinary services are resilient, and they're growing in rural and regional locations, driven by a number of different factors, including regional migration. The changes in the labour market, as well as our flexible workplace offering, are delivering higher levels of recruitment of vets to rural and regional areas. We've got a big focus on expanding our earnings margins, and doing this by providing high standards of care to drive up average transaction values. The additional cost savings from the redundancy and restructuring programs flowing through. There's further efficiencies that have been identified at clinic level to increase margins, and really trying to get leveraging the synergies from the scale of that we provided through the acquisitions. As I said, we don't intend to acquire any further clinics in the balance of FY24 as we prioritise free cash flow and reduce our debt. So overall, we're expecting to continue to deliver further growth in FY24. I'll leave it with that. Thanks, Mark.
Thanks, Chris. And yeah, we've had a slew of questions come in there while you were talking from a long-term shareholder. I think it's fair to say. One of the questions, and I don't think you touched on it in your in presentation, but so it might be good to just go over it, was $2 million that was incurred as part of a large stock loss. Maybe just delve into that or give a bit more context to that. Was that, I don't know, pet food that expired across the clinic network, or maybe just give us some kind of context on where that came from?
It related to some surface protectants and sanitizers that we acquired during the COVID period, which were at a high price, and we've been selling them generally into both the Australian and US pig market. The pressure on those products, with the markets at the moment, they're declining. So as the producers have been saying, well, is there a registered claim that shows that they have a long-term efficacy that we can, pay a premium for those products? And our regulatory person has been working extremely hard with the regulators, both in Australia and in the US, to be able to get those claims for long-term disinfectant, and so that we can provide a premium. So, so a few months ago, a regulatory person came to us and said, hey, they've just exhausted that opportunity. There's currently no standards in place, and as a result of that and further market feedback, basically those products have to be sold as up against similar products with similar claims, and the claims on these products are just as surface protectants and sanitizers. So as a result of that, we have made provision for the write-down of those, because they're still selling very well. They're very effective products, but because we can't get those long-term claims, they're being valued at the same cost as similar products.
Okay. And then another question on stock coming out of escrow. I think there was an announcement earlier in the week. The first part is how much stock is still in escrow, and the question is most of this, I'm guessing, is related to deals that have happened in 22, 23, which are now coming out of escrow, and what's kind of been previous experience for vendors who've had their stock come out of escrow. They're just kind of wanting to know the impact given the kind of the low liquidity, low turnover in a stock like Apiam.
Yeah, well, I think you pretty well nailed it there, Mark. I mean, at one stage when we were doing lots of acquisitions, we were doing up to 30% of the consideration as script, and as that's come out, those people have stayed in the business. They retain those shares, and they're looking to grow them, but some of those who have exited the business have decided to sell those shares, and obviously, as you say, with low liquidity, it has a significant impact on the share price. 12 months ago, we actually made the decision that might not be 12, maybe 6 or 7 months ago, made the decision not to stop issuing scrip as part of consideration, and the last 2 or 3 acquisitions have been on a 100% cash deal.
Okay. And then just another question around pet stock investments. I think is one of the substantial shareholders controlled by Woolworths, I believe, are according to our question. Just a question around, have you had any engagements with them in terms of, trading corporately? I guess, what's kind of their view on their investment in Apiam?
Yeah, so I mean, Woolworths haven't acquired pet stock yet, so that transaction is still to occur. But having said that, yeah, we're in regular contact with pet stock. We actually have a joint venture with them in operating clinics in some of their stores. So we're in regular contact. To date, we don't have any further information as to what the Woolworths acquisition might be, what the impact of that might be. But we're certainly continually having discussions around how we can benefit from having a relationship between the two companies. And then we've had one question emailed in earlier, and we've had another one come through now, just on the debt levels. Is there a target you'd like to get down to, or try and I'm just thinking of the higher interest rate environment that we're in now. Where would you like to see it kind of settle if we look out 12 or 18 months from now? I mean, the way that we look at it, we're trying to get our operating leverage down around 2. So at the moment it's sitting around 3. So that's really how we we target. If you look at the business is generating pretty good cash flow, particularly if we can continue to grow the revenue, take some costs out, then we're going to generate more cash. And then obviously if we're not making acquisitions, that'll get applied to reducing debt.
And another question that was kind of emailed in by somebody who couldn't join us this morning was, is there a possibility of dividends being reinstated when we get into FY25? Because I do recall Apiam used to be a fairly regular dividend payer from memory.
Yeah, that's correct. I think we ceased dividends about 18 months ago, with the intention to reinvest that into what was some pretty exciting opportunities with acquisitions, and and we've done that. So, our scale is where we want it to be now, where we can really start to get some, leverage some of those synergies and get some earnings expansion. So, yeah, in terms of dividends, our chairman at the AGM last week, made the point that our focus is around growing earnings, and as we grow earnings, then it would make sense then to to recommence a dividend program.
Okay, perfect. And maybe this is one for the annual report. I'm not sure, Chris. Is it outlined somewhere in the annual report how many shares are still in escrow?
It will be. I'd have to have a look because there was some came out again the other day, but there'd be with some of the equine clinics that would be still in escrow, but coming out, there'd be around maybe 5 or 6 million shares. I'd expect that would be still in escrow, but it's probably a matter of just having a look at when we made acquisitions and knowing that the majority of them, half of these shares that were as consideration would have been in escrow for 12 months and the other 50% for 2 years.
Okay, great. And then if we can squeeze in one more question, on the map of all the clinics that you had up there, South Australia, wasn't represented at all. Was there a particular reason you didn't want to enter the South Australia market, given you're kind of right next door there in Victoria?
I mean, we currently provide services into South Australia, so particularly in the pig industry, the feedlot industry, we've just picked up some business in South Australia in the dairy industry, in our pro dairy business. But all those businesses don't require physical presence in there. We do have staff that operate out of there. We just to service our clients, but we don't have any physical clinic. And the reason behind that is it's fairly simple, is that the clinics that we acquire, we want large clinics. There needs to be 5 or 6 veterinarians as a minimum if they're in regional areas, because, as I said, they have to deal with their own after hours, and it's very difficult to attract vets into clinics unless they've got sort of 5 or 6 vets. If you look at South Australia, there's really only 3 regional cities essentially, and a few other regional towns, and there's not many of those that actually have clinics the size that we would typically acquire.
Okay, perfect. And then one final question, if we can just squeeze it in, Chris. I know we're just over on time. EBITDA multiples on the recent acquisitions, if we say like early this year, the back end of last year, have they really changed materially over what they have done by? I think people are just trying to get a sense of where recent deals have landed versus maybe ones from 18 months, 2 years ago.
Yeah, so there's definitely a softening in the multiples. So, so we've been, in COVID, some of those larger clinics, particularly equine clinics, we were, between 6 and 6.5 times. Now the last couple, I think we've acquired closer to 5 times. Okay. So, yeah, so the multiples are definitely softening, which makes sense with with the cost of funds and things.
Yeah. No, it's a natural flow on, as you say. Chris, I know we're slightly over time, and I do want to respect your time and everybody else's, so I think we'll leave it there. Thank you very much for coming back and joining us and giving us an update, and hopefully we can get you back on again in 2024.
All right, it's great. Thanks, Mark.
Thanks, Chris. Thanks, everyone. And I wish everybody a good rest of their Thursday.